Thank you so much for having us here, and thank you for putting on this conference. I guess the first thing I need to do is say, can you hear me clearly?
Yes.
So that's good. So, and Yaso, Fen Milao Lenika. I know not everybody here is Greek, but some people are. And so those are my 5 words of Greek that I could give you. I have spent quite a bit of my life in and around Greece and Cyprus, and you guys live in God's country, those of you coming from Greece. So let's dive into what I want to talk about, and I'm going to share my screen. I don't have slides, but it will kind of lead and guide the conversation. And so what I wanted to do is something that I've done differently in the past in conversations that I've had. I think that I'm well known for having written this book, The Education of a Value Investor. And the thing that I did there, which perhaps was new in the investing world, is that I kind of tore off the kimono and kind of showed the inner thoughts of somebody that is kind of on a path of trying to be smart, trying to follow Warren Buffett, trying to invest well, and what was really going on inside. And so I'm happy to take questions on that, and I'm happy to talk to you about where I am at today. But what I wanted to try, and it's an experiment, so I'm slightly nervous, and I thought about putting slides together and decided that that was not the right approach. I'm going to talk to you guys a bit like how I might talk to a friend if I was sitting with him over a coffee, and think about return on invested capital. So, and I wish I had a blackboard, and I'm not going to try and create some kind of whiteboard here. But you're just going to have to bear with me, and I'll try and go slowly. And unfortunately, I don't see your eyes, so I won't know if you're understanding me or not. But I do see George. So
Guys,
George,
can you make it bigger? Can you make it bigger? Because it's very hard to see the small print.
That is an interesting question. I'd love to make it bigger, but I don't know how to do that, George. But don't worry. This is just a web page. Actually, I'm using a piece of software called Rome.
Okay.
But it's not all that important. It's really my notes. And in a certain way, imagine you're looking at my notebook. I just threw these down in various notebooks and then put them up here today. But George, if you think that I'm explaining stuff well, do nothing. But if you think that I've made myself unclear, you can raise your hand and say, no, you haven't done well enough there. Let's just talk for a second just about return on invested capital. And so we can come up with businesses or investment opportunities that might have a high return on investment capital or low. So if I put up a cement plant and earn very little money from it, it barely makes a return. That would be a low return on invested capital. I put, let's say, $100 in, and I can only squeeze $1 out. And then we certainly have businesses that Warren Buffett talks about a lot. I'll talk a little in a minute about See's Candies, for example, where very little capital was invested in the business, but it pours off enormous amounts of capital. And that would be, there are many examples that we can give. But the first distinction that I want to give you is that what we're really interested when we're looking at different investment opportunities is the return on reinvested capital. So if I will just start now, and what I've done is I wanted to kind of like, I played with various different kinds of charts to try and group investment opportunities into different types. I think the investment world is a bit more like a rainforest. And so it's just easier to talk in a certain way of different species or groups of species of investment opportunities. So here are some examples, and I'm sorry if it's really small, of companies that have, and just to go back to my first point, we're talking about reinvested capital. The first distinction that we have to make is a company might have a high return on the capital that was invested in the past, but what we're really excited about and interested in is the opportunities to reinvest capital at high rates of return. And so for those of you who don't know, this is literally just going to take us to a link of See's Candies stores. This is a American company that makes chocolates. And it turns out that they do really, really well on the West Coast of the United States. but they have had real problems, and they have actually given up trying to expand beyond the west coast of the United States. So the company generates something like these days a few $100 million free cash a year, but that's it. There's nothing you can do in the business. In fact, I had a meeting once. I visited one of their factories, and I kind of was coming up with all sorts of examples of how they might reinvest their capital. And the CEO basically said, forget about it. It's not going to happen. We've tried all those things. Every single investment project did not earn a return. What we do is we send the money back to Berkshire Hathaway. So there's one example. I want to give you another example that is dear to my heart. This is a coffee shop in New York City called Via Quadrono, which used to be my favorite coffee shop when I lived in New York City. So this is on 73rd and Madison. You just see a photograph of it there. And this is an article that if somebody wants, I can send it to you. But the company was started, or that coffee shop was started with very little money and a little hole in the wall and an incredible manager of the business. And the business just hummed. It was full of people, and it was full of some of the richest people in Manhattan, all buying coffees and talking to each other and meeting each other. And I kind of like at the time said to the owner, I'd like to own a piece of this business. And he was constantly trying to convince me to invest in another coffee shop that he was about to open. And my response to him was, I don't want those coffee shops. I want this one in this location. Again, a cash generative business, but didn't know where to put the cash. So, and then my last example is the WD-40 company. And I can tell you, for your interest, I spent quite a bit of time in the past examining WD-40, and they make, again, this is just so that you see what it looks like. That's the product. Pretty much everybody's familiar with it. And this, by some lucky combination, the product plus its branding has made it a dominant brand in its little niche. But it's very, very hard for them to extend the product line. It's very hard for them to do much else than produce this product. And I kind of was all excited about the company, but I hadn't made the distinction between reinvested capital versus return on invested capital. So George can show you the mathematics, and somebody else, or maybe I could some other day, that if you have a business in which you can earn high returns on reinvested capital, you've got a really beautiful thing going, and you should be willing to pay up a lot of money for it. And the question is, how to identify them at a time when the rest of the world hasn't figured it out. So what I want to do now is just talk to you a little bit about two examples of where there is a reinvestment opportunity, but it's a low return reinvestment opportunity. So if we just think of government bonds for a second, the great thing about government bonds is that you're going to get, well, let's just assume it's not a zero interest rate or a negative interest rate environment. You're going to get that return. It's not going to be much of a return, but you are going to get that return. And that's already a big plus in comparison to, let's say, some manager who might be managing See's Candies, who might be reinvesting the money in projects that just waste the money. At least in government bonds, you're earning 1%. And I think that in general, real estate is an example of where, to put up new real estate requires huge investment. You have to, buy bricks and mortar. You have to bring workers to the work site. You have to put up the building. Once you have the building up, there's a very high likelihood that you're going to be able to earn a rate of return. It's not going to be a very high rate of return, but it's kind of like pretty, it's not hard to achieve. So there's kind of like a different end of the spectrum, and it's an end of the spectrum that we all know. It's the risk-free end of the market. I then want to take you to another kind of species, I guess, of investment opportunity, which I've called Capex-free growth. And I think that it's important, or I think that where I'm coming to, and this is just that George, this is not Guy Spier with finished thoughts. This is still trying to develop and understand what's really going on. But we can look at, I've listed here Microsoft in the early years and Google in the early years. So if you take Microsoft, Bill Gates comes up with an operating system for a PC, which is completely different to the IBM mainframes. And this thing is kind of on fire. Everybody's using it in all sorts of ways. And it's kind of like a bit like, we could call the explosive growth a bit like what COVID did to the human population. It's expanding. You can't even think in terms of invested capital because it's expanding without any investment of capital. And if we think in the same way of the Google search algorithm, the thing expand. And so I think that from, obviously, these are amazing businesses and they're fascinating to look at. They're very, very hard for somebody like me to invest in because there's not really analysis that one can do other than the binary, this thing is going to take over the planet or not. And at the point at which I figured out that this thing is going to take over the planet in its particular area, you know, every venture capitalist in California and a whole bunch of other people have figured it out as well. But I think that, you know, what I propose to this group is that to take a certain category of company and not even talk about it in terms of return on invested capital, to just say this is an explosive growth situation is perhaps easier to deal with. I think I kind of created a second kind of subcategory, which is rather than, it's still Capex-free growth, but it's sedate Capex-free growth. So if we imagine that corporations go through a life cycle and they start off as a small torrents of water in the mountain, and eventually they become sort of slow-moving rivers at the estuaries and going out into the sea, there's that middle ground where there is sedate or maybe a faster moving stream. And if I think of the general network services business of American Express, and forgive me, I could spend 2 hours talking about it, but I'm assuming everybody here has some knowledge about this. And if not, this will give you a good jumping off point. But Visa and MasterCard are also networks that in a certain way don't really require a capex to grow because people just keep adding themselves onto the network. And as the network grows, it becomes more valuable and more people want to add themselves to the network. But they've been around for long enough that there are characteristics that I can identify and analyze and understand. So, and we're going to get to the investment sweet spot here at the bottom. And then my last point will be the role of the CEO. And so I think I'll come in at around 25 minutes. But so now I want to talk about another category of companies, which is called, that is not the right one, seeking network dominance. So I think we're all aware now of these incredible Moore's law and Reed's law in which the number of people in the network, there's exponential returns, the number of people you have in your network. And so Amazon was perhaps the first proponent of this, but what we had was extremely smart CEOs who understood this network dominance effect and who were willing to spend practically every single penny on the company's balance sheet to achieve network dominance. And again, it's very, very hard to think in terms of return on invested capital there because the outcome is kind of binary. One outcome is that you achieve network dominance and then you're a very profitable company and you've got network dominance, or you don't. And I think that I didn't put in here WeWork, but WeWork had that mindset in which they were seeking to achieve network dominance. Amazon seems to have achieved it in multiple different businesses, including cloud computing. And I created a subsection for cloud computing because, and I've listed here, and I'm reading out these names because I apologize that this is appearing small on people's screens. You know, just 4 examples of actually Uber's there a second time that shouldn't be in there. Snowflake, Elastic, Datadog, they're all companies that are seeking to achieve network dominance in cloud computing. Again, I just think it's not worth trying to think in terms of return on invested capital there. You take the combination of the network economics and the insane spending that is taking place where they spend every last dollar to try and get there. It's one of these things that's a binary outcome. I think that then we get to 2 places where perhaps it's a little easier. So in this case, so if we go back to Via Quadrono, my favorite coffee shop at the time, they could invest in new coffee shops. And if they invest a small enough amount in new coffee shops, some will succeed, some won't succeed. And so you take a portfolio approach. That's effectively what Google Ventures is. When you think of Waymo and when you think of other moonshot projects that they have, you can decide that they have a sufficiently large portfolio and that sooner or later one of those things will succeed. So we could impute that across all of those projects, there'll be a good return on invested capital. I'm not sure that I'm comfortable with that, but it's a kind of like an approach to trying to understand whether they will have high returns on reinvested capital or not, separate from their search business. I also put in there VC firms in a certain way. I'll talk about all three together. VC firms, movie studios, and music studios. They are seeking to create an environment in which their portfolio approach, so they will fund, at VC firms, they'll obviously fund new firms. Movie studios are going to fund new movies. You're going to get hits, you're going to get failures, but across the whole portfolio, you're going to do okay. And it's an approach where I would be investing the VC firm to see what are they doing and how will they maintain their deal flow of deals that are more likely to succeed or not. So I guess all this brings us to, that's kind of like tossing out of the whole ROIC question, situations that are just not analyzable. And so in a certain way, if I was advertising this to my friends, I'd say, don't come to me and start trying to talk to me about ROIC calculations for all of these other kinds of companies. That leaves a very specific universe that I think is really interesting and valuable hunting grounds for people like me with my skills. And I start off with railways just to talk about it. So what you have with the railway is that you have a network, and those networks move through places which are not reconstructible. So once you have one railway tunnel, you're not going to get planning permission for another one. They're going to say, we've got one, we don't need another one. Or if you have a railway going through a center of a town, you're not going to get people saying, we'll authorize another railway for your competitor right next door. That means that when you as a railway company, but a difference between, let's say, that Capex-free growth that I talked about at Visa and MasterCard, for example, in order to grow that business, you need real Capex. You might need to build stations or goods loading docks, or you have to put down new tracks. It's significant amounts of money that you have to spend, but you're in a privileged place to do it. And so that creates the ability to be quite analytical about what kind of rate of return you're likely to get on your reinvested capital. And you can start thinking about some kind of carrying capacity. What amount of capital can this business take? So you have here, I've put down railways, I've put down pipelines, I was just doing some Google searches here. I thought I had to show some images. And, just to give you that sense of a different kind of network. I mean, we just have photographs here of different oil and gas pipelines. In the United States, if I just bring this up for a second, many of these oil and gas pipelines are owned by specific companies. And it's not a monopoly, but it's not free competition either. If you want to deliver oil or gas in this particular part of the United States, there's probably only one or two companies that you'll be able to deal with in order to get that done. And those companies' investments to help you will have a privileged rate of return. So oil and gas pipelines are interesting businesses to look at. There's also, I've named one of the companies, Air Liquide. These are companies that produce industrial gases. But in order to produce industrial gases, you have these very complex plants. And those plants are connected to your clients via pipelines. And the same thing again, once you have a network of clients there, it's very, very expensive for somebody else to come along and put in their own network. But those are businesses that can take quite a lot of capital in there. And I think that my point to you, George, and when I say to you, it's really to this assorted company. From an investment standpoint, I'm not looking for the highest possible returns. First of all, just to go back to my first point, there's no point me buying a company with a high return on past capital invested. It's not going to help me with the new capital that's got to invest. But I'm actually looking for something where I can be very confident that over the next 10, 20, 30 years, those returns will be stable and will be higher than the risk-free rate. And I'm actually not looking for the highest possible return, because I will trade the highest possible return for something that I can predict and is stable. And so I've come up with 3 more examples here. One company that's kind of just really intriguing to me is this company, Pool Corporation. Just to give you a sense that it doesn't have to be in the technology space, or it doesn't have to be in the super sexy space. Pool Corporation is, they are a specialized distributor of swimming pool consumables. And normally the kind of thing that you need in order to take care of your outdoor swimming pool, you would have imagined you'd buy it from a supplier like in the United States, Home Depot, or a construction supplier. It turns out that the exact combination of needs of physical stuff investment stuff like pool tiles or special pipes and pumps, combined with the consumables, means that you can justify a completely different distribution channel with different distribution centers. And so this is a company that has been growing over the last 20, 30 years to supply many parts of the world now, significant parts of Europe and the southern United States, with their swimming pool supplies. And there seems to be, and I say seem because I still haven't gotten to the bottom of it, a kind of a predictability about how that business is developing. I'll just give you 2 more examples before I talk briefly about the CEO. So we have an obvious example with restaurants, and I just listed 2 here, Starbucks and McDonald's. Those companies went through an explosive growth phase, but obviously new stores have a kind of a cookie cutter. You can do the economic analysis, and the brand kind of takes care of what's going to unfold in those stores. So, and the last one, which is a bit like pipelines, is this cell phone towers, where you can have a very predictable. It's really fun to just put up one of these photographs. And I'll just bring this over. And I hope you don't mind my low-tech, just Google searches of phone towers, just to give you an example and to give some visual element. So the point there is that once you have a tower up, unlike an apartment building where you can only have one person move into the apartment, this could represent 5 or 6 different cell phone companies. And if yet another company wants to rent space on your tower, you could add yet another antenna at no incremental cost. So once you've got your base investment, there's extremely high return on incremental invested capital. So, so those are some examples of sweet spots where I try to look. And then I just want to say a couple of words about the role of the CEO. What unfolds for me as I kind of spent time thinking about this is that what you really want is a CEO who understands and matches the nature of the opportunity set that you face. So if you're in a See's Candies, or if you're in a Via Quadrona coffee shop, you want a CEO who's really happy to run that business and is really happy to send the cash somewhere else, period, end of story. On the other hand, if you're in one of these railway or pipeline business, you want a CEO who can do a careful analysis and pick the very best reinvestment opportunities, but who stays within his lane. I think that there are just very, very few companies, if we go to the portfolio approach, which I'm missing out here. This thing is even too small for me. There we go. There is perhaps where you need some of the most talented and capable CEOs, because they're investing new and different reinvestment opportunities all the time and seeking to create an environment where over all of them, they will do well when you take it across all those different projects. My point is, there's no one great CEO. You have to match them to the different varieties of investment vehicle that you have, or the different species, if you like, of investment opportunities that you have, or investment So in conclusion, and I see that I'm coming up to half an hour, which is, I think, my allotted time. I hope that I've given you, in spite of the small text, a sense of where my mind is in terms of thinking of return on investment capital. And hopefully it will give you a sense of at least how I seek to categorize and understand when I come across a new company or new investment opportunity, or somebody talks to me about something, where am I trying to put it? And one of the things I'm trying to do is to allocate it to one of these different species and then see what I do with it. And with that, it's such a pleasure to be here. I hope that I've been somewhat entertaining. I hope I've been clarifying. I took a risk by taking this approach. I wanted, rather than to present that I know everything, to give you a sense of where my mind is on a particular topic. Thank you, George. Back to you.